Good morning, I'm Jordan Thompson with Citywide Mortgage Services, here with my colleague, co-broker, Reza Sabor. Thanks, Reza, for joining us.
Thank you for having me.
We're going to be talking about something important today, and Reza is also one of the directors of the Mortgage Brokers Association of BC. So today I'd like to speak to you about a proposed legislation that is being proposed to the Office of the Superintendent of Financial Institutions, also known as OSFI. They have put forth for public consultation a recommendation of a stress test for uninsured mortgages, whereby an added 200 basis points will be tacked on to the contract rate for qualifying for a mortgage. So what does this mean in plain English for people who are looking at getting a mortgage?
Yeah, so it's a really good question, and I'm really glad that we're covering this topic today because it's going to become something that you're going to hear a lot more about over the next few months. If these proposed suggestions, I should call them at this point, by OSFI actually end up becoming something that gets implemented by the Bank of Canada and obviously all the lenders, it could have a pretty drastic effect on approvals for clients. And most people are obviously used to hearing insured mortgages having a stress test. That's something that's been implemented now for quite a while. Last year they made sort of a change to that as well, where all insured mortgages had to now be stress tested. But this is the first time, and it's a bit unprecedented, to request uninsured mortgages, so borrowers who actually have 20% down or higher, to also be stress tested. So that could have a very, very large impact on a very big percentage of borrowers. 200 basis points essentially translates to 2% stress test. So that's important to understand. So if you were going to normally qualify for a mortgage at 3%, let's say, you would now be required to qualify 2% higher than that, so at 5%.
So that's at 5%. And that is the amount that we use for qualifying, not the actual amount that you're going to pay.
Absolutely.
So if we're having to qualify you at 5%, I mean, what is that going to do? For the average client and the average mortgage size, you're probably looking somewhere between a 20 to 22 to 23% reduction in what they would qualify for. Prior to the stress test, if that doesn't get implemented, they would obviously qualify for a lot more. Typically, the industry has always been to the movement of when you have 20% down, generally insurance is not involved. That's right, and you're less risky.
You're less risky. You're perceived to be less risky to the lender, and therefore the insurance is no longer necessary. And you unless you're getting a variable rate mortgage or a mortgage of less than 5 years on the fixed side, typically you would qualify directly at the contract rate.
That's right.
So that's the proposed change here, and it could have a very drastic impact on the market.
I mean, that's a huge increase. A 2% increase is, I don't even know if rates are going to be going up that amount. Is it even a plausible number?
It's a number that's obviously very conservative and very, obviously they've thought about this at OSFI, and this is one of the things they want to introduce. But it could be potentially quite, I don't want to say damaging, but it could definitely impact people's ability to borrow quite a bit. It could have large repercussions for the market. You could see a lot more influx of borrowers now having to go to provincially regulated lenders like credit unions, who may have to take on more clients now than they're maybe used to, as well as non-provincially regulated or non-federally regulated lenders like secondary lenders and things like that, who would have to try to take in the inflow. And that could impact real estate prices. That could impact people moving from one location to having to settle for a location they weren't thinking about because they have to move to a lesser expensive area. So it could really have ramifications of all sorts, and it's really a waiting game to see if how it would impact it, but it will impact it.
It will,
for sure.
And we saw this happen for insured mortgages back in October of 2016. And I'm sure Reza can attest to, as well as can I, that it did affect our clients and made it much more difficult to qualify for mortgages. And I'm sure you've got some examples where the impact of having to qualify at that higher rate was very, quite frankly, upsetting for many.
Yeah, absolutely. I mean, it's important to understand the stress testing itself is not a new concept. Prior to the ruling in October 2016, stress tests were applied to insured mortgages,
yes,
but only when those terms were less than a 5-year fix. So if you
yes,
had a 1, 2, 3, or 4-year fixed, or if you wanted a variable mortgage, that's the only time you were stress tested.
That's right.
After that ruling, all insured mortgages are now
Yes,
stress tested, regardless of the term and or type of mortgage. And so now this potential change would be, again, unprecedented, because now we're looking at going after borrowers who have saved up 20%, typically have very good credit, typically do have very good stable income, and so in a sense we're punishing the segment of borrowers that have always done the right thing by being told to save up their money and sort of get ready to sort of have a part of that Canadian dream. And also you have to remember that this is a federal regulation, so it would impact the entire country, while really Ottawa's principal point in doing this is to cool down 2 cities, Vancouver and Toronto. But you're now painting that with a broad brush across the entire country. So provinces that are sort of in the middle of the country, the prairies and things like that, where affordability is typically better, are now going to struggle too, because they now have to qualify at a higher rate, and you're sort of implementing that across the country. And it just seems a little bit of an overstretch.
Yeah, absolutely. Interestingly too, with the insured mortgages, now we have to qualify at the benchmark rate, which is 4.84. So as Reza was saying, if we have an uninsured mortgage and it's 2 points or 200 basis points higher, and current rates are approximately 3%, it's actually even a higher rate that we would have to be doing the qualification at.
Essentially, yes. This 2% would pretty much replace the existing currently 4.84%. So 2% above whatever the contract rate of that mortgage is, and whatever term you've chosen. So, it's definitely going to make some waves. This is probably one of the largest and most impactful changes that's been proposed in, I would probably say, in the last 20 years. And it could have, like I said, major effects across the board for all borrowers and lenders.
One of the examples I want to give, and this is for the insured mortgage, I have a client who makes a decent living, salaried, has lived in Vancouver, works in Vancouver, and has so for 20 years. His income is currently $46,000 per year. And given the new stress test on the insured mortgages, he is able to qualify for approximately $165,000, which is very upsetting for him because he lives and works and has for 20 years here in Vancouver. And even though he does, he has saved up, he's got a decent down payment, it's going to be very difficult for him to remain anywhere near Vancouver, given that small mortgage amount. So I can certainly see that for people that might have 20% or 30% already saved up, they're saying, well, wait, I've done everything right, I've got all this money, and now you're imposing this stress test that's way higher than what I actually have to pay. And
absolutely,
6 months ago, when I qualified, I qualified for $500,000, and now you're telling me I only qualify for $400,000.
Yeah.
So that's a fair drop.
It's a fair drop, and it's important to remember that this new proposal doesn't really care what the size of your down payment is.
Exactly.
Above 20%. So you could have 70% down, and you only need a 30% mortgage, and this would still impact you. So it is a pretty far-reaching and rather on the extreme side in terms of a measure to cool the market down. Obviously it will definitely have an impact. I'm just not sure it's the impact the government would have necessarily wanted when they see the other ramifications that are going to come as a result of this. And so as a provincial association, obviously trying to have the best interests of BC residents in mind, and also as a national association, I think this is one of the things that we're going to be trying to voice our concerns over, and trying to work with the government to hopefully have them consider some of the notions that we're going to be bringing up as well.
Yes, because I think it certainly can have some unintended consequences as well. I want to thank Reza, Director of MBABC and fellow co-broker at Citywide, for joining me today. And Reza, for anybody who'd like to learn more, can you tell us how to contact you?
Yes, absolutely. If there's anyone who has any other questions about this proposed guideline, or really any other guideline, you're more than welcome to contact either one of us. We're both mortgage brokers, and we both work at DLC Citywide Mortgage Services. So you can contact me at reza@citywidemortgage.ca. Yes, exactly. Or you can go to civilmortgages.com, and all the links and information will be there as well. You can also check out MBABC by Googling them, and we're always updating information as we get it, and trying to educate the public as well.
Great. Thanks, Reza. Have a great day, everybody.
Thank you, guys. Thanks for having me.